Thank you, students. I'm trying to explain something to you today, which is called the share option. Although we are facing these difficult times at this present moment, but I just thought that will be very helpful if I can basically just give you just an overview of what a share option is. A share option is when someone has been given a right to acquire a share. It's not an obligation that you must buy, but you've got a right to acquire a share, and usually that share is issued at a price lower than the market value. Right. Now remember that if you issue a share at a price lesser than the market value, some will be for free, some will be for value. We call them no value and for value shares. Right. And we did that under rights issue. Now in explaining what basically we're seeing here, you'll realize that we've got just an extract, and this extract here, I've got 200,000 shares. Although my money or my monetary value is 400,000 this side, it only tells you that each share roughly was issued at 2 rand. All right, and then you go further down to here where there's 100,000. There's 100,000 number of shares which are cumulative preference shares, and in monetary value there's 100,000 rand. So it means one cumulative preference share there is 1 rand. Now what I've seen is that some students, when you say to them how much is the dividend, they use this number here. They use this number, which is wrong. The number that you're supposed to multiply the 10% with, this 10% with, is this one, this 100,000, the money, the monetary value, meaning the rand amount in terms of this dividend that you're supposed to calculate. So the dividend, if you look at it from here, it's 10,000 because it's 10% multiplied by this amount that I've highlighted here, there. Right, and then we go to the next one. The next slide gives us an extract of the statement of profit or loss and other comprehensive income. Remember, when calculating basic earnings, you will use the profit after tax, which in this case you can see it's written profit for the year. That is your starting point of basic, meaning I'm talking about the 175 and the 210. Obviously from those amounts, the 175 and the 210, you need to deduct your preference dividends first. Right. Now then we get to this slide. Additional information. You can see that I've highlighted 1 March 2014 in red. It is very important that you find out when was this basically share option issued, meaning when did it start to exist. So if you look at it this way, on 1 March these 100,000 share options were there, so you know they started existing there. It's very important to know the date when they started to exist. And you'll notice when you read further, it says you'll get 2 ordinary shares, right? And although these 2 ordinary shares are for 2 rands, they were issued at 3 rands per share, right? Now that means if you take the information as it is, I've got 100,000 options and I'm going to get 2 ordinary shares for every option. So it is clear that if I want to know how many shares will be issued in terms of this exercise, it is 100,000 times 2, which is 200,000, right? And the issue price is 3 rands, and the market value is 5 in this case. Now, if you go further in terms of this and you look at your required now, you are required to prepare and disclose basic earnings per share and diluted basic earnings per share. Most students, they don't read that part. They end up giving you things that you didn't ask them. Like in your test, some of you gave me ordinary dividends declared, ordinary dividends per share. And when you ask yourself a question that if you look at the required, we never ask you for that. So in this exercise, you are only asked for two things: basic earnings per share and the diluted earnings per share. Right. Now we go. Now you've got the reconciliation of basic earnings there at the top. Now this reconciliation of basic earnings there at the top tells you that you have to calculate how much is your earnings that are supposed basically to belong to ordinary shareholders. Right. If you look at that, you will see that already I've told you that 100,000 in rands. No, it's not 100,000 in rand. Yeah, it's 100,000 shares times 1 at 10%. That's basically that. Now, that will give you a dividend. As you can see, I've already put numbers there to say my dividend will be 10,000 here. So 175 minus the 10 is 165, to 10 minus the 10 is 200,000. Those are the earnings that will belong to ordinary shareholders. Right. Then I come to the number of shares. Shares have not basically changed. They are 200,000. If you check from this slide, you'll see that we've got 200,000 ordinary shares. So there's nothing basically that is being said here that requires us to change the weighted average number of shares, the ordinary ones. So we go back here. You can see that we've got 200,000 shares. Meaning basically for the 2 years, they've always been 200,000. Now, if I want to calculate my basic earnings per share, obviously for an example, in 2014, I'll take the 165 and I'll divide it by the weighted average number of shares in 2014, which is 200,000. As you can see here, below here, I've already basically done the calculation. For 2013 is 200,000 divided by 200,000, which is 1. I've done the calculation for you. Now, what is the next requirement that we need to basically deal with? They said we must give them basic earnings per share and also diluted earnings per share. Now, if you want to do anything that has to do with diluted earnings per share, let's say for an example you want to calculate the earnings. Your starting point in earnings when you want to do diluted are these two, the 165 and the 210, the last figures that you see under basic. When you go to the number of shares, what is your starting point? These figures that you see here at the end. Always you start your diluted with the last figures that you see under basic. Right. Let's go to the next slide. Now you'll see it says the earnings under diluted EPS is the same as under basic EPS, but the number of shares will change. Now, when we are dealing with an option, the only part that must change is the number of shares. The earnings, when you look at diluted and when you look at basics, their earnings will be the same. Right. Now let's check what I'm saying that it is correct. Now, if you check here, the earnings are 165 and 200. Those two figures, when you are dealing with options, they won't change. The only change that will happen under options are the number of shares, as I was basically saying here. Now, as it says there, the earnings under diluted EPS is the same as under basic EPS, but the number of shares will change, like basically as I was explaining now. The starting point is to use the closing balances under basic earnings. I've already explained that part. Now, What you need to know is that this sentence says only the potential shares that are for free. So this is the line I'm talking about, will cause a dilution. So since we are going to issue shares below market value, some shares will be for value, some shares will be for no value. If you remember, we did that under rights issue, right? The same way here as under rights issue. Now, you remember I highlighted the date 1 March 2014 in red, which is 10 months. Now, as this basically sentence says, share options were in existence from 1 March 2014, which is 10 months. That is the dilution period. So what I'm simply saying, I'm saying, you look at that date and you say, okay, these options were there from 1 March. So 1 March until December of 2014, they were there. So they are going to cause a dilution for that 10 months only, right? Now let's look at the calculation. The calculation says it's 100,000 shares, so 100,000 options times 2 shares. Let's basically make this to be clear. Ordinary shares, right? It's 100,000 options, so you can see what we are saying. So it's 100,000 options times 2 ordinary shares. Remember they said for every option that you have, you're going to get 2 ordinary shares. So then in total now we've got 100,000. We've got 100,000. No, not 100,000. We've got 200,000 ordinary shares. They were issued at 3 rands. How much did you get? You got 600,000 for them, right? But now remember, the market value for these shares is 5 rand. So now the question arises. You see the 600,000. How many shares do you need if you issued the shares at 5 rands for you to get 600,000? So if you divide that 600,000 by 5, which is the market value or the fair value, it tells you that you only needed 120,000 shares. So you can see 120,000 times 5 will give you 600,000. So you needed 120 shares to get 600,000. Now, if that is the case, you issued 200,000 shares. As you can see here, you issued 200,000 ordinary shares. But you didn't need all of them. If you issued this thing at 5 rand, you only needed 120. So here, it shows you that I issued 200,000 shares, but I only needed 120. Therefore, 80 were no value shares, meaning the free ones. They are free, these ones. Let's say so. Alright. So, and remember what we said. We said here at the top, we said only the potential shares that are for no value will cause a dilution. So the ones that we want, it's this 80. The 120 we are not worried about. We are worried about the 80 that is for free, this one. Right. Now, then we're saying here, use these share options. Right. In effect, we should be saying use these are now ordinary. These are now ordinary shares. Use these ordinary shares because they've already been converted now from options to shares. So use these ordinary shares. So now, here's the issue here. These are in existence from 1 March 2014. Right, the share options. So, if you go here, these ones that are for free, they can only cause a dilution for 10 months because it is from March to December in that year of 2014. Right, in 2014. Now, if you notice this calculation here, it tells us that there were 80,000, but they are going to cause a dilution for 10 months because they've been in existence for 10 months. Then it gives us this 66,667. Now, I want you to notice something in terms of this calculation. Look at 2013. The figure there is 0. Why the figure is 0? Because the options were not there in 2013. They only started to exist in 2014. So you can't have a dilution in 2013. The dilution is in 2014 and it's only for 10 months. Right, you'll see now that the number of shares will change. From the opening of 200,000, you'll add the 6667, it gives you 26667. Now 2013 will still remain the same. Now the actual column, you'll see it's 280, which is the actual number, the total number that is for free, and then it gives us 280. Right. Then we go to basic diluted earnings per share. Now, the profits, they've not changed, still the same as under basics. Right, like I said, the profits won't change. The ones that you use under basic will be more or less the same as under diluted if you are dealing with share options. Right, let's qualify that that rule applies only in share options, whereby the profits or the earnings don't change, but the number of shares will change. Right, then we come here. If you look at the number of shares now, it's 266, like basically we've calculated there at the top, right? This one here for 2014, and for 2013 we have this one as well. Now let me give you the rule now. You can only have a dilution if your diluted earnings per share is lesser than your basic. Now, what is it that I'm saying? I'm saying, let's compare. This is my basic. Here is the calculation for 2014. My earnings per share is 0.83. Now, if I go and compare it to 2014, this one here is 0.62. So it is lesser than this one. Right, so there's a dilution here because 0.83 is lesser than, so no, 0.83, this one here, is bigger than this one. Right, so there's a dilution if this figure is lesser than this one. Right, there's a dilution, meaning the figure must decrease from basic to diluted. It must be a decrease. Now look at 2013. It's 1. 2013 is 1. So the expectation is that if there's a dilution, when I go to diluted, it must be lesser than 1. Right. Now when I go here, I find out that it is 1. So there's no dilution in 2013. There's no decrease. You see. So we can then conclude that a dilution is in 2014 because you see basic is 0.83. Then your basic diluted earnings is 0.62 here. So there's a dilution in 2014 because this 0.62 is lesser than 0.83. Right. Now, if we go now further here, this is disclosure. It is very important to put things where they belong. Right. Very important to put things where they belong. your basic earnings per share and your basic diluted earnings per share, they'll go here, just underneath the face of this statement of comprehensive, sort of statement of profit or loss and other comprehensive income. Right. And then you've got this disclosure note. This disclosure note will tell you that under basic earnings per share, you need to tell us that what is it that you took to calculate basic earnings. You took the basic earnings per share is based on the earnings of 165. Last date was 200,000, and the weighted average number of shares of 200,000 ordinary shares in issue during the year. Now, that note in your test, remember you had rights issue, you had capitalization issue. When you've got shares that have got an element of being issued for free, you must talk about them there. You must talk also about the adjustment of the prior year figure, right? So if there was a rights issue, there was a capitalization issue, there was a share split, talk about them there, and you must also tell us that the prior figure has been restated. Now we come to basic diluted earnings per share. You also basically do the same thing as basic. You explain how it was calculated, and you must also say something about the share option because it is the one that is causing a dilution in this case, right? Now then we come here. Now I'm asking a question here. How will diluted earnings per share change if share options were in existence from 1 March 2013? Now remember, which means now if these options started existing in 2013, they will cause a dilution in 2013 for 10 months. They will cause a dilution for 2014 for the whole year because they are in existence for the whole year in 2014. Now, the calculation is still the same. You will notice now that we are saying use these ordinary shares like we said before. Right. Notice here, in 2013 you've got 80 times because now according to this exercise, so if we say now they've been in existence from 1 March 2013, so for 2013 is 10 months. So you'll see here in the calculation we're saying for 2013 it's 10 months. That is the reason why the 66 is here. Right. Now you come to 2014, which is this one. It's 80,000. You see, I know that 12 over 12 is 1, so it doesn't change much, the 80,000 figure. But I just wanted to demonstrate to you that for 2014, it's there for 12 months. 80,000 times 12 divided by 12 gives you 80,000. That is the reason why you see 80,000 here, right? Now, this is basically the actual number in terms of that. Now you'll see when you look at your basic diluted now, if that was the case, it will look like this. Notice something. You see, your basic diluted earnings per share for 2014 is 0.58. That amount is lesser than this one, 0.83. Now also notice that for 2013 it is 1 there, and that amount is lesser than the 0.74. So in terms of this slide, if the issue date of these share options was 1 March 2013, the basic diluted earnings per share will be as follows: 0.58 and 0.74. And there's a dilution. There is a dilution for both years 2014 and 2013 because 0.58 and 0.74 are lesser than the basic earnings per share. Right. And we go on. Then we come to this one. So here we're saying how will Again, I'm asking another question. I'm changing this thing. I'm asking a different scenario. Now I'm saying, how will diluted earnings per share change if share options were in existence from 1 March 2012? Now remember, now this means that they are going to be in existence for the whole year in 2013 and for the whole year in 2014. That is the reason why you'll see that both these years here, there's 80 here, there's 80 here, right? So they are going to be there for the whole year, right? You can see here, I'm saying there's 80 times 12 divided by 12 for 2013. They are in existence for 12 months. And I'm doing the same thing for 2014 here. They are going to be in existence for 12 months. Now, if you look at the calculation here, is 0.58 and 0.71, which are lesser than the basic also. So, which means there's still a dilution in terms of this. Right. Now, here's a question again. As we keep basically doing this thing, we just want to check that we understand what we are doing. Now, what happens if the share options are in existence from 1 July 2030? Now, keep in mind, if they're in existence from 1 July 2030, it means in 2013, they will be there for 6 months. They're in existence for 6 months in 2013. Now, you'll see here, right? We'll say use this ordinary shares. Now look at it. 80,000 times 6/12 is 40 for 2014, because for 2014 they are in existence from 1 July 2013. So from 1 July 2013 to December is 6 months, right? Now if you go to 2014, for 2014 they'll be in existence for the whole year, because they are there for the whole year, right? Now that will give us new figures in terms of the basic diluted earnings per share, 0.58 and 0.83. That will basically be the new figures in terms of this one. Now, student, notice that this exercise is straight from your handout that you have as class example, I think 5, yes. Now, the what if options that I've done on these slides is just to demonstrate to you how do these exercises change. When we change the date, how do basically your answers change in terms of this exercise. So I hope that this will assist you in terms of tackling